Hi, it's Alex here, and today we are going to talk about how you can make a car payment with a credit card. Whether it's your first time buying a vehicle or the last time, there are tons of different ways that you can make your payments each month without breaking the bank or maxing out your credit cards. And by doing that, you'll be able to pay for the vehicle and still have enough left over to put it towards other things too. You're probably always on the go and don't have time for anything less besides work, so using one card for everything in your life can be really convenient. But is this really the way forward? Let's find out. If you are new to this channel, you will find answers about credit cards, saving money, growing your income, investing and saving for retirement. So without further ado, let's get started. This video will cover three main topics: making a down payment with a credit card, paying monthly installments with a credit card, and finally paying off your car loan with a credit card. Let's start with making a down payment. In many cases, your lender or the dealership may ask you to pay for a percentage of the car purchase in advance. It is also known as a down payment. Now, dealerships may require a down payment of cash or an equivalent form of payment such as a money order, check, debit card, or electronic transfer. The down payment may be paid in cash, a trade-in vehicle, or an automaker rebate, and is usually a percentage of the car's purchase price. Others, however, may accept credit cards. Sometimes it's a great idea, and sometimes it's a terrible one. You might be eligible for a low down payment or no down payment, depending on the lender, your credit health, and your vehicle. For example, for a new car, you should aim for a 20% down payment. In the first year, the value of a new vehicle can depreciate by at least 20%. If you make a big down payment, you will be less likely to end up upside down on your loan, which is to say you have more debt than the current car is worth. Now, the depreciation rate on used car is lower, so a smaller down payment of 10% or more might be a better idea. Now, the question is, should you make a car down payment with a credit card? It's important to first determine if a credit card can be used to make a down payment on a car. Credit card down payments aren't always accepted by dealerships and auto lenders. However, if the car dealer or your lender allows it, consider these potential pros and cons first. In addition to earning rewards like cashback or airline miles for a car down payment, using a credit card with rewards may also allow you to earn cashback. The down payment you make on a new credit card may also help you meet the initial spending requirement for the bonus rewards points. However, this approach will only be beneficial if you have the cash to make down payment and if you want to pay off your credit card balance on time. In any other case, you will be charged interest. The introduction APR offer will help make up for this downside, but I'll go into details in a minute. In addition, you should check your credit limit to determine how much you can afford to charge. It's important not to use the entire credit limit of your credit card. Now guys, credit utilization could increase in that situation, which could negatively impact your credit score. You'd essentially be making two payments for the loan and your credit card monthly if you choose to use a credit card for the down payment. If these two payments are not within your budget, I would consider reducing them. As well as that, there are additional details to remember. Although bill payments may be able to be set up automatically, maybe with autopay, there is still an extra account to manage. If you use a credit card to make a car down payment, you could potentially pay more in interest than if you finance your down payment differently. Auto loans are secured loans that are secured by the vehicle you'll be buying. The loan terms is typically 24 to 84 months, after which the vehicle will be paid off. Now, there are many lenders, including national banks, local credit unions, and online lenders, which can provide auto loans. Due to the nature of auto loans, they are typically more affordable than unsecured options such as personal loans. Average APR for a new car is anywhere from 3.24 to 13.97%, depending on your credit score, while the average APR for a used car is 4.08% to 20.67%. Now, of course, those who have credit cards with zero introductory APR offers may be able to pay down their down payment on a credit card and then pay back the remaining amount over time without paying interest. Keep in mind, however, that besides your loan payments, you will still have to pay a minimum amount on the card. The interest will be added to the remaining balance if you are still paying off the balance at the end of the promotion period. If you use a regular purchase annual percentage rate card, this could result in a substantial amount of interest, which leads to the second topic, which is paying monthly installments with a credit card. Now, credit card rewards can seem irresistible, especially if monthly payments are high. If you are planning to pay your car loan directly with a credit card, you must know that most lenders won't allow it. In any case, you would probably need to pay an additional fee in order to pay with your credit card. A lender may charge this fee for the convenience of using a credit card. The fee typically costs between 2 to 3%. Are you really not interested in paying more of your car than you already do? However, there could be options to try if your car dealer accepts credit cards. If you have a credit card that has 0% introductory purchase APR, you could skip the loan process altogether. If you use your credit card for this method, you can make payments without incurring interest. In most cases, these cards offer introductory periods of up to 18 months. Nevertheless, a high enough credit limit will ensure that you can afford the full price of the car. Furthermore, you need to locate a dealer who accepts credit cards as payment for the entire purchase price. Now, a loan with this term may be an option if you think you would be able to repay it in the time frame and have good credit. However, convenience fees may still apply. Cash advances are one of the worst ways to pay for a car with a credit card. This is because many credit card companies charge interest immediately without any grace period. Furthermore, you won't be charged interest based on your purchase APR. The APR for cash advances is much higher. An APR of 25% or higher is typical for cash advances. The cash advance fee is 3 to 5% on top of the high APR. Clearly, this is an expensive way to make an auto loan payment. Now, when faced with a monthly car payment, here are a few things to consider if you find yourself struggling to make ends meet. Get in touch with your lender. There are many ways to obtain financial assistance from your lender, such as renegotiating the loan terms, deferring payments, or offering other forms of financial assistance. You can refinance your auto loan. Your loan could be more affordable if you obtain a lower interest rate or lower monthly payment, which leads us to the third topic, which is paying off your car loan with a credit card. Guys, if you can pay off your auto debt within the 0% period, moving the debt to a credit card could save you money on interest. You could end up paying a heavy price if you make a mistake though. You're essentially transferring debt from one place to another with a credit card if you pay off your car loan with this method. Paying off a card loan with your credit card closes the loan account and turns the balance into a credit card balance. Now, let's assume you have an auto loan of $15,000. Using a credit card, you may be able to pay off the loan amount if you are approved for a balance transfer credit card. Now, credit cards for balance transfers offer a 0% introductory purchase APR for a limited time, usually 12 to 18 months. Therefore, this is another chance to use your credit card to make interest-free payments. Of course, a downside is the balance transfer fee, which could range from 3 to 5%. You should make sure that transferring your debt from one method, let's say an auto loan, to another, which is a credit card, will actually save money on interest, as well as making sure that you have the financial discipline to pay off your credit card before the introductory 0% APR period expires. Guys, you should know that credit card interest will skyrocket if you don't pay down the balance. It may be more advantageous to refinance your auto loan in order to reduce your payments. Now, the potential advantages of moving auto loan debt to a credit card with a 0 introductory APR is that will save you money on interest. Now, that assuming you pay off the loan before the 0% period ends. Credit card APRs are usually much higher than those on car loans, so be sure that you can actually raise the debt in time. When you pay off your auto loan in full, you'll be the owner of the vehicle. A secured auto loan means you can be repossessed if you fail to make the payments. Now, in contrast, credit cards are unsecured. However, you shouldn't use this as an excuse to default on your credit card, as this could seriously damage your credit. You could earn reward points or cashback if you are able to pay off your loan with a credit card, which could be the main reason of doing it after all. Now, as final thoughts, taking on another loan while paying off your current loan is a risky move. The system only works when you repay and spend responsibly. Now, to even consider this method, you should thoroughly analyze your financial situation. This makes it easier for you to prepare yourself to deal with the responsibilities of repaying any loan. You should definitely take a look at your monthly budget, including income and expenses, before you apply for a credit card. Credit cards with 0% APR will typically offer balance transfers options for up to 18 months. Be sure you can pay off your loan within the specified time and get a balance transfer credit card that helps you achieve that. You'll usually have to pay a fee to transfer a balance, which is typically between 3 to 5% of the amount transferred. If you expect to pay off the balance fairly quickly, this fee may be more than you'd save on interest. At the same time, when you get a 0% APR credit card, be sure to read the agreement carefully. Well, remember, credit card companies charge interest on the whole balance, not just the remaining balance, if you do not repay the whole loan within the introductory period. Keep an eye on the APR on a balance transfer after the introductory period. It will help you get an overview of the costs involved if interest is added. You'll likely pay a lot more interest than you would with your auto loan if you still have the bulk of your auto debt on your credit card after the 0 period ends. Also, an unexpected financial emergency can derail your budget, making it harder to eliminate plenty of debt quickly. Even if you think that your payment habits are great, there is still always a possibility that you might face a financial emergency. You should always have an emergency fund on hand. With that being said, thank you so much for watching. Don't forget to let me know in the comments if you got any value from this video. It's 2021. Please subscribe. Hit the notification bell if you aren't already, and I will see you soon.